Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meizinger, your host, and today I'm pleased to be the presenter also, where I'll be talking about covered calls using ETFs. Many of you know I'm the host for the FX series, where we deliver FX content every Tuesday, normally at 3 o'clock Eastern Time, and then we deliver ETF material at 4:30. So, and that always occurs on Tuesdays, or most of the time, Tuesdays. So today, I'll be talking about using the covered call strategies, the advantages, the disadvantages. I'll be using, as an example, the First Trust ISE Revere Natural Gas ETF. The symbol is FCG. And today it was down 2.6%. And how you might use the covered call strategy. So without further ado, let's get started. Again, my name is Steve Meizinger. I'm the Director of Education at the International Securities Exchange. I've been at the ISE for 9 years. In fact, I'm just about to start my 10th year. And I've had a lot of fond memories here at the ISE. Is delivering educational material. We were the first fully electronic exchange, and we deliver many, many benefits to the end user. When I say end user, that's all of us. As I work at the ISE, but of course, you're an investor in the market, so the ability to have transparency, to have lower costs, many different benefits, many benefits for electronic trading. I would urge all of you to get a copy of the characteristics and risks of standardized options. Options are not suitable for everyone. So you should get a copy of that. You can get it at your broker. You can also go to optionseducation.org and get a copy. Today I'm going to be using FCG as an example. That all it is an example. It should not be construed as any investment advice, as you need to consult with your broker or your financial advisor, whoever that person is, on the suitability of any kind of investment product. You should also consider taxes, margin, and commission in any option strategy. So please go to optionseducation.org. Great place to go to learn more about options. Also, you can get a copy of the characteristics and risks of standardized options. All right, let's get started. So review of the benefits of ETFs. Well, the ETF market has completely exploded over the last 17, 18 years. Well, what are the benefits? Well, we have increased portfolio flexibility. But prior to ETFs, if you wanted to be diversified, you'd have to buy a bunch of stocks yourself, and therefore buying all of these stocks yourself would create tremendous costs, bid-ask spreads, the commissions themselves. So the cost of transacting is a lot lower. When you're looking at ETFs, you can get diversification. Now, when you talk about diversification, in many ways, many definitions of diversification. I might look at a broad-based ETF. It's going to give me a lot of diversification. I might look at narrow-based ETFs, and that's what the example I'm going to be using today is a narrow-based ETF, the First Trust ISE Revere Natural Gas ETF, and that will diversify relative to just buying one or two natural gas companies. But again, everything is relative, so you're going to get diversification. But if you wanted broad diversification, you look for a broad-based ETF, such as SPY. And there is relative tax efficiency, at least compared to index funds. If you have any questions, I'll probably tackle the questions at the end of the presentation. But please type them in the chat box. And I would love to answer your questions. Some other considerations for exchange-traded funds. The one challenge is that because you can trade throughout the day, it might lead to overtrading. So please think about what are your goals, what are your risk tolerances. It's very, very important. And lower diversification does not mean that you're completely 100% diversified. Depends, as I mentioned, on the ETFs chosen. Diversification typically moderates your portfolio results, for good or for bad. And a lot of times when I'm teaching options, it's the same thing. When I'm teaching option spread strategies, I might say to someone, you know, these vertical spreads are going to moderate your results rather than buying a call or a put. Because if you're buying a call or a put and the asset goes up a lot or down a lot, depending if it's a call or a put, well, that is going to be a big advantage. But if it doesn't move all that much, then you'll see, actually, you might see losses, so spread might be better. So it always depends on how far that asset might move. So I'm looking at diversification using ETFs. I'm going to moderate my portfolio results. Think of it logically. If I could find one natural gas stock that I could be 100% certain that it's going to outperform everything else, well, then I would just buy that one and really not need to worry about the others. However, I have to have reasonable expectations. The stock that I pick might not really be the one that is going to be the outperformer. So if I want to hedge myself, I might want to buy. Maybe I'm more bullish on the industry itself, and I don't want to make a one company play. Well, therefore, that you might want to consider ETFs. Also, the nature of some ETFs are very complex and hard for investors to understand their components and how they're priced by the marketplace. So when you look at the double and triple shorts, there is a place for those, but you got to remember that those kind of ETFs are more of a very short-term trading tool, very short-term, because they're actually repriced every night. So I get this question often, what should I be thinking about when I'm looking at ETFs? Well, you should be thinking about your own goals and your own risk tolerances and understand the goals of that specific ETF, the goal of that specific ETF. So in this case, and I'm going to get to it in FCG, it's just to own a group of stocks, and it's pretty straightforward. But there are other ETFs that are not as straightforward. So please understand that. That doesn't mean you couldn't make money at some of those more complex ones, but also you might lose more money. But just understand risk and reward. ETFs, what are they? Well, they're similar to mutual funds, but they're traded throughout the day on exchanges as opposed to mutual funds that are priced at the close of each trading day. So that gives you a benefit. If I decide at 2 o'clock in a day like today, maybe I've been optimistic on the markets for a long period of time, and around noon today, I saw the market down, and maybe I thought that the market was going to continue lower. Well, the ETF market allows me to exit my position at that moment rather than the mutual fund where I have to exit I put my order in, but I'm really just priced out at the end of the day. So just understand the differences between a mutual fund and an ETF. ETFs trade throughout the day, have tremendous transparency, where the mutual funds are priced at the close of each day. Using options with ETFs. So that another benefit is that you can actually hedge or maybe set up a different strategy. When I'm using the covered call, I'm reducing my risk a little bit. I'm not completely hedging it because I have some downside risk, and I'm going to get to that in a brief moment. But I can use options, and there are lots of strategies. The most important thing to understand is that you can customize your own risk-reward trade-offs. So if I felt that the market was going to be in a neutral trading zone for the next X number of months, well, then I might want to sell some calls. If I thought the market was going to make a big move up or down, I might want to consider a different strategy. So there are bullish strategies. You could even use spreads. Bearish strategies, again, you could use spreads. And you could also create vol positions. So what's a vol position? It's a different topic for a different day. But in fact, I'm going to actually pose this to all of you and see who can be the fastest typist. Has anybody ever heard of a back spread? And can somebody give me an example of the goal of the back spread and what it is. How would you define a back spread? We're not going to talk about it, but just wondering if you guys know what that term is, back spread. Let's see if anybody... If anybody's having problems with the audio, you just have to call back in. Okay, back spread is essentially, thank you everybody, so that's a different topic for a different day. I'm going to have to deliver that presentation very soon, but a back spread is a volatility position. Essentially, that I might think that SPY, FCG, QQQQ, or any other ETF, if I thought that that market might make a big move, but I wasn't certain in which direction, I could back spread it. I might want to sell an at-the-money option and buy 2 out-of-the-money options, and that's called a back spread. But again, I will build a presentation, and I'd urge all of you, we have a big crowd today, and I want to thank all of you for attending, but please come back in the future when I talk about back spreads. But today we're talking about covered calls. Essentially, it's pretty straightforward. I'm going to sell an option against an underlying position. And one of my favorite phrases that all strategies work, they just don't work all the time. And you should definitely learn the advantages. Michael says it's a ratio spread. That's exactly right. Thank you. I'm talking about the back spread. You may want to learn the advantages and disadvantages of any of the strategies before you enter an options trade. I would highly, highly, highly recommend you to understand why the strategy would work and why it wouldn't work. So what kind of market conditions do you need? Whether I'm talking about a back spread, a bullish vertical spread, or a bearish vertical spread, or a simple call or put, covered call, what have you. You want to know why it would work and why it wouldn't work. So why would you consider an ETF? Well, you might have a view on the broad market or a specific sector, and you prefer not to select one stock from the market or from a specific sector. So if you were looking at the market and you might see your surrogate is a XYZ stock, but what if it starts to underperform? So you could look at the broad market, whether it's SPY, QQQ, or any of the other popular ETFs. Or if you're looking at, let's say, natural gas, you wouldn't have to just pick one natural gas stock, but you could pick, in the case of the FCG, you could pick that whole ETF and you get a group of stocks rather than just one. So let me define that, the FCG. Well, the name of it is First Trust ISE Revere Natural Gas. The symbol is FCG, and has recently been gaining in market popularity due to exposure to natural gas without the technical monthly futures contract role. I think a lot of you know that there's another ETF out there that was popular and is still popular, but it does require that the fund sponsored, essentially, the way that they built that ETF was that it controlled futures contracts. So then you're worried about contango, the idea that you might have higher prices in the future, and that's a problem. So if you really wanted a more straightforward way to invest in exploration and production of natural gas, FCG might be a great opportunity for you. Again, the simplest way is to pick one or two stocks. However, if you wanted to be a little more diversified and be in the natural gas sector, FCG is it's one option for you. So take a look at it. Again, you should always go back to your broker, your financial advisor, or whoever helps you make these trading calls. But at least you understand what FCG is now after you spent just a couple minutes with me on this webinar. So what is the fund objective? And this is, I mentioned this briefly. You really should read through. A lot of us don't do this, but you should really go through. The fund sponsor goes and gives you a fund objective. So you go to the website of the sponsor, and in this case, I'll read it to you. This exchange-traded fund, meaning FCG, seeks investment results that correspond generally to the price and yield before the fund's fees and expenses of an equity index called the ISE Revere Natural Gas Index, and that's trademarked. So it's an equally weighted index comprised of exchange-listed companies, so they're all traded, that derive a substantial portion of their revenues from exploration and production of natural gas. So to me, very straightforward. And the index is constructed by establishing the total population of stocks listed in the U.S., companies involved in the exploration and production of natural gas, and then eliminates stocks whose natural gas proven reserves do not meet certain requirements. And so you can read, I'm not going to go through every bullet point, but you can go to FT Portfolios, www.ftportfolios.com, and learn more about it. And the index is rebalanced on the application of that above model on a quarterly basis. So as of recently, in fact, I think this was, I should have had the date on here, I believe that this was, these are the holdings as of December 31st. So again, we're going to get a rebalance on March 31st, but right now, these are the top 10 holdings. So Sandridge, Chesapeake, Forest Oil, Talisman Energy, SM Energy, Devon, Cabot, Suncor, Stat Hydro, and Range Resources. Those would be the top 10. You see the corresponding percentages and the symbols. So you could always pick one or two, or again, there are a zillion option strategies or a zillion investment strategies that you can use. And here's the chart. So when I put this presentation together, I don't know the exact date. I should have had that on there, but about a week or two ago, this was priced at $21.34. Today we closed at $21.90, so we actually rallied a little bit from there. And again, if you guys are technicians, you might have said, wow, well, obviously, well, I shouldn't say obviously, but if you were a technician, you might have liked that trend and thought it might have gone higher. Well, it has gone a little bit higher. But again, technical analysis is not perfect, and we all know that also. That's why we have option strategies to protect us from changing markets. So there's the chart on FCG. And here are a couple of the components, and this is what I like to see. I like to compare the components to the index / ETF, and you'll notice in this case, strangely, as strange as it is, that you're going to see a lot of these components are acting a lot like, so we're not seeing a lot of variance. Of course, these are the top 10 components. So you see a sort of a new high here in SD, Sandridge, and the bottom pane is the implied volatility. That's the 60-day implied vol, and the blue is the historic volatility. So quite a gap there in Sandridge. Not such a big gap. Chesapeake's been in the news quite a bit. I'm sure a lot of you followed, and had a nice breakout at that 22 level. Got up to about $30. And you'll see that these are all trading very similarly, which is interesting. Here's the Forest Oil. Now, they're all going to vary as far as the degrees. You'll notice that Chesapeake is way above its short-term moving average, and Forest Oil is not, so we might all have different views on what that means. And here's Talisman, and that's pretty far from its moving average also. At least it was a week or two ago. Same area, land and exploration, same sort of thing. And then you look at the option volatility. The yellow line is what you actually get paid if you sell an option in relative terms, or if you're buying an option for insurance, for protection, what it costs you to buy an option. And I like the relative strength. I'm using Live Vol Pro, and you'll notice then if you take a look at these 5 stocks, and then the ETF, you'll notice that 3 of the stocks were outperforming and 2 were underperforming. And that's when you think about indexing, if you will, and basically an ETF is an index, except you get to hold that group of stocks, is that you're getting some of the good ones and some of the bad ones, and you're averaging them all out and getting, if you will, that average value, the FCG, which is all 30 stocks, I believe it is, or 31 stocks, whatever. You want to go, definitely want to go take a look at every stock that's in this. ETF. But you'll notice that you have SM is actually outperforming and SD is underperforming, although the CHK is now sort of, looks like it's now not performing as well, and the yellow SD might start to outperform depending on your view of your investment horizon. So here it is, the different stocks, and then the red is the ETF itself, FCG. So what about options? And I hope you're all enjoying this. I tried to throw something that was a little different, and rather than, I'm going to get to covered calls in a second, but I think this is important to understand that if you're looking at a certain ETF, you want to know what's in the ETF and how are these stocks acting. These stocks that are the highest weightings, well, you want to take a look at these and see where the performers are and where the laggards are. Options are available for all of us, so we can hedge FCG. We can buy a put. We can buy a put spread. And today I'm going to talk about hedging using a call. I'm going to sell a call to hedge my underlying FCG position. So the selection of an option strategy, well, what's it based on? It's based on my view of, depending, of course, how I look at the world, how I look at investments, my view of fundamentals, technicals, charts, of course. And again, I love looking at implied vol. I was a floor trader for over 20 years. And then I want to compare it to the market's view of fundamentals, the market's view of charts, and then your view of implied vol, or I should say, that really should be the market's view of implied vol. Ultimately, the final decision is, what do you consider? What do you think that the market will do based on it? Do you think the market will move less or more? So do you believe that that market will move less or more? That's essentially the premise of either buying or selling an option. So if I looked, and if I go back, and I looked at FCG, and I say, look at the yellow line, that's the price of insurance. That's the price that buyers pay to have insurance. And if you think that insurance might not be needed, then you might want to think about selling a call option or a put option, depending on your investment strategy or option strategy. The relative cost of insurance is down in that bottom pane, and it tells you what investors are looking at. So if you go back to last May, were premiums high or low? I'm going to pose this to all of you. Premiums high or low last May? Premiums were high. Thank you, Terry. Premiums were much higher then. And then we saw another spike when? In the September period? In the August period. So mid-August, a little bit of a spike, and we've seen a decline ever since. Well, the decline means that many investors are on the same side of the proverbial fence, that they believe that we're going to be in a market that will probably stay neutral or rise a bit. And if that's the case, that they're not preferring insurance. So they're avoiding insurance, and if many people are avoiding, when I say insurance, it's the need to buy a put option to protect. So fewer and fewer people feel that they don't have that need to buy the put option, then that price is going to come down. You see the relative value for the last year has been coming down substantially. So even though we're going to talk about covered calls today, we do have to recognize that the option premiums are a lot lower today than they were last April or May. Well, May for certain. If they go back to April, we are even lower than last March.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.